Most people today are not managing their own money. They willingly hand over their life savings to the so-called experts throughout their lives and lose hundreds of thousands of dollars to the management fees. And more often than not, the experts will underperform the market. They will give you many excuses why it happens. And the core idea they will try to tell you is, you can never manage your own money better than they did. Listen, whenever there is a narrative in the investing world, you must make your own judgment whether it's true or false. You must understand that everybody on the market want to make money for themselves, and there isn't anyone you can truly rely on. For example, many of you have heard the narrative of an index bubble, where fund managers accuses passive investors for mindlessly buying ETFs and warns about an imminent crash. Is it true? Of course not. If you just do a little research, you will uncover their lies very easily with strong evidence from the past studies. Deception like this is very common in the investing world, and that is why we must arm ourselves with knowledge and understand our edge as individual investors. Once you are able to fully utilize these concepts, you can easily outperform most professional fund managers. I have personally done this for the past 6 years without paying a dime to the fund managers. In the past year, my portfolio has grew $200,000, outperforming all major US indices. I will keep uploading content to this channel to help you achieve the same or better result. And all I ask in return is to give this video a like and subscribe to this channel. Professional fund managers usually oversees billions of dollars in assets. The sheer size make it extremely difficult to achieve any outperformance. A $10 billion fund can never build a major position out of a $100 million company. It will be only 1% of the total fund, even if the whole company is purchased outright, which will have very little effect to the overall return. Then there is the liquidity limitations. For a retail investor, the stock market is completely liquid. This means any trade we made will be executed almost instantly. Unfortunately for fund managers, trading stocks is much harder. Let's say a small investment fund with only $1 billion in asset is trying to invest in the EQB stock. This is a stock that I personally hold with outstanding performance in the past 5 years. To have a meaningful exposure, the fund need to build at least a 5% position, which means buying $50 million worth of EQB shares. The stock has an average trading volume of about 74,000 shares. Given its current share price of $109 per share, there are only $8 million worth of stocks available to trade every day, way less than the required amount. To make it worse, there is no way a fund can purchase the entire $8 million daily volume, because doing so will completely drain the liquidity and bid up the stock price so much that the investment will stop making any sense. As a result, fund managers has to make private transactions with large shareholders to settle trades, which usually means paying a higher price than on the public market. A lot of investment funds have restrictive strategies that undermine long-term performance. For example, a high dividend fund can only invest in stocks with dividend yields higher than a predefined threshold. Let's say one of the high-yield stocks in this fund has become extremely successful. Its share price skyrocketed, and the management decides to invest capital to pursue growth opportunities instead of growing the dividends. A wise viewer like you can already guess what the fund will do. Because of the high share price and stagnating dividends, the dividend yield plummeted below the threshold, and the fund manager has no choice but to sell the stock, no matter how much he likes the company. The same thing also happens for funds that only invest in small cap stocks. If a stock becomes successful and its share price goes up, it will stop being a small cap stock, resulting in forced selling and missed opportunities. I can keep going on and on to show you more examples, but I believe you already get the point. Most investors are short-term focused, and fund managers have no choice but to keep them happy. Imagine what will happen if a fund manager picks his own stocks based on a proven long-term value-based strategy, but he underperforms the market index for a few months. Almost immediately, a lot of investors will start to sell out and flock into other funds to chase higher returns, leaving this fund manager with loss of businesses and even the loss of his job. As a result, most fund managers will stick with the safe investments, most likely stocks picked from the S&P 500 index. If their portfolio crashes with the market, they will be completely fine because all of their peers are in the same boat. They can simply blame the market and easily convince investors to continue hold their funds while they continue to charge fees and enjoy their easy jobs. Some fund managers, like the infamous Cathie Wood, would chase the most hyped-up stocks in a market bubble to gather great attentions and huge amount of money from naive investors, charging expensive management fees and making herself very rich in the process. The party always ended in the same way, that is horrific loss for the investors. The ARK Innovation Fund lost 80% of its value in 2022, and the ARK family of funds destroyed a staggering $14 billion in total wealth. As a retail investor, you never need to give a damn about what other people think. You have the complete freedom to ignore the short-term market fluctuations and only focus on buying stocks that will do well in the next 10 to 20 years, making millions for your retirement savings. Most actively managed funds follows a fixed management fee schedule, usually 1%, which is much higher than any index ETFs, the retail investor's favorite. The high fees charged by active funds stays the same regardless of its performance. Just a 1% higher fees will have huge implications for your future net worth. The fund managers has absolutely no incentives to make money for the investors. They just need two things: an okay performance compared to other underperforming fund managers, and a better than average advertising strategy to convince you to hand over all of your savings. That's it. Then they will just sit there and extract as much management fees as humanly possible from your money. So instead of buying an active mutual fund, investing in passive ETFs, or even picking your own stocks will result in much better long-term performance in most cases. By the way, if you wish to level up your wealth into the next level and unlock the ultimate freedom, make sure to show some love by hitting the like and subscribe button. See you next time.